we give it the obligatory one minute.
Yep. So give me the beard update. Was there any shaving, or is it all still intact?
No, it has been kind of maybe a little bit trimmed over here and over here, but I think the idea was this is the primary time capsule. This is the day-to-day measurement of the length of shelter in place. That's the theoretical idea behind it. But
is Mindy cutting your hair?
No, she's not. She did, but it's been managed through the process. It's being, and I think Mindy would tell you it's been overly actively managed, but
that's how we roll.
Yeah, I mean, I think it's a tiny bit like cleaning the garage. It's a little addicting, and you always see one more thing you could do. So, so I've been kind of tinkering, maybe perhaps too much, but it's hanging in there okay, I would say. And I would say I've gotten pretty good at it, and so we're gonna keep it going for a little while. But I do consider Cheryl, who I've had for 20 years, an essential service. So I can't wait to go back and have her fix all the little nicks and cuts and all that stuff. So,
all right.
Yeah.
Okay, so we should get started.
Sure.
Good morning, everyone. I'm Lauren Moon. I'm here with Don Garman. We are doing our Tuesday check-in with you all. Don,
green.
Oh, green
I get another credit on the good side for the green.
Don mentioned this last week, but we're going forward having a little bit different format. On Tuesdays, we'll be doing more of an interview format, talking about a specific topic, and Fridays we will do a market recap of the week, give you some highlights, and that'll most likely be coming from Don. So without further ado, today we wanted to talk a little bit about how we view portfolio construction going forward. And I know some of us, Don and I, listened to Warren Buffett's Berkshire Hathaway shareholders meeting on Saturday, and he had some pretty interesting things to say, the main headline of which was that he got out of airlines. And so coming from somebody who isn't afraid to buy low and ride it out, we thought this was kind of an interesting indicator that clearly he sees some semi-permanent change going on in at least some subsector of the market. So we've been talking about that in our investment committee this morning, about how that might be reflected in our portfolio. So Don, my first question for you is, how do you think portfolio construction is changing going forward?
Yeah, great. Thank you. So I think it's an interesting topic for us to at least include our fans and friends into the discussion on. So I thought it was interesting that the Berkshire call for a lot of reasons, but one of them was the contrast between what Berkshire or Warren Buffett as the leader of Berkshire said and what they did. I thought that was a very interesting contrast, because I think the playbook we would have all expected was that, you know, pandemic, blood in the streets, opportunities that have sort of been the hallmark of Warren Buffett's investing style, and, you know, others before him, back to Benjamin Graham, is, you know, when you get these savage pullbacks, that you can step in and get great opportunities. And I thought it was interesting, and you obviously highlighted the most prominent headline from the meeting, which was it was interesting if you didn't pay attention or watch the meeting. Warren Buffett said they decided to take 10% of all the major airlines as a position, and just say, and as he did the analysis, they estimated that Berkshire's share of the profits of those companies was about $1 billion, and they spent about $8 billion to get that $1 billion of earnings. And that in the Q1 of 2020, during the heat of the pandemic and the worst month in the stock market ever, all they really did of note was sell all those airlines. And so that was a startling, I would say, admission that the basis for them buying that stake had so fundamentally changed, and for so long, that they thought the most prudent thing to do was get that capital out. And you saw the number, as I did, They were net sellers of over $4 billion of US stocks during the worst month of stock market history. So, so that was interesting. And that was, and what the note that I came away with from, and I think it was Charlie Munger that said it, you've already heard me say this, but when asked about how they are riding out this pandemic period, he said, we feel like we're the captains of a ship in a typhoon. We want the typhoon to pass before we're ready to reestablish a new direction. And so that isn't dissimilar to how we've been viewing this as well. As we've talked about many times, I think it's completely appropriate to have less risk on at a time when so many foundational U.S. industries are being rethought, from commercial real estate to leisure travel to Disneyland parks to our own office here. This is all being rethought in real time. So for anybody to put all their chips on the outcome seems premature to me.
And we talked about that this morning in terms of changing how we view diversification, meaning you don't necessarily just hold everything to hold everything because it will move differently, but being more selective about what, we all know we're selective about the stocks that we choose, but also I think the sectors. So going into that, how, taking this to the next level, how do you think a client's portfolio might look differently 3 years from now?
Yeah, I think that's, the way I view this period, and I think you share a lot of this, and I know I'm speaking for all of us when I say this, like, we are definitely of the opinion that there is very likely to be a different group of companies that are dominant, not than the 5 dominant ones now. I think those are very highly likely to continue reigning supreme in the market cap, in the presence of the market. But I think what we're going to be looking at is staying in sectors that we think have very high probabilities of growing faster than GDP as a whole, and avoiding other sectors maybe completely. Like, I don't think speculating in tiny sectors of the S&P 500 for bounces is going to be where a lot of wealth will be earned. I think we're going to have to be really good at managing risk. I think we have to understand that putting money in a 10-year treasury at 60 basis points or 0.06% per year for 10 years, or 30 years in a treasury at 1.3, when the Fed has said we will keep printing money until inflation is 2 or more, guaranteeing losses in those assets over some long period of time. Don't believe me, Warren Buffett spent an hour, I think, on the similar subject on Saturday. But it's basically a guaranteed loser, as is holding massive amounts of cash for a long time. Purchasing power erosion is real. People who don't keep up with inflation in their income, if you're just eroding your principal, it's a guaranteed loser. So I think that embracing some level of volatility, owning what we think are known, strong, survive and get stronger assets, and then having a segment of the portfolio in, what we have now, biotech and healthcare and things that, with the aging population and all of the change that will be coming, there will be some things that have complete no relationship to what GDP does in terms of how they grow and how successful their businesses will be. Won't matter.
So to summarize, in terms of how portfolios will look different, it sounds like we may be putting in place more of a shift in terms of active sector or asset allocation calls, whereas we may have had kind of at least some weighting to every sector and made active calls with a specific
like markers, like market weight exposure to these segments, which had been perfectly valid GDP growth plus whatever, or with a nice income profile attached. I think that stuff is going to be okay, but I think it's going to be a little bit of a different playbook. And let me just put one sharper point on that, which is we debated this a little bit in our investment committee, and I don't want to get too technical, but if yields are going to stay at 0.06, then maybe 21 isn't outrageous to pay for stocks, and maybe 25 is in the mix. So there is
Times
this,
earnings is what you're talking about.
yes, times earnings. So there is a multiple expansion element that could be at play as well with the companies that are just secular growers. Jonathan made a good point in our call, which is, these are still very small percentage of the world has migrated to the cloud, has adopted these new productivity enhancing innovations. There is a lot of market potential ahead. So that is why we haven't traded out of any of these, massive companies that we own, but why we will be comfortable adding to them in some size on pullbacks if we get them, and just holding them if we don't.
Mm-hmm. All right.
Yeah. Was that really what we wanted to cover today? I think. Yeah. I mean,
I think so.
Sorry. Say it again.
You covered my questions. Anything else you want to talk about?
No, I mean, again, I think the portfolio of the future will obviously be largely made up of the groups that we have in there now. And I think to have those individual situations where we think there is some powerful driver underneath of sort of fast earnings growth will always be present in our strategies. And besides that, managing risk, I think, is going to be the name of the game. If it's 60-40 was the portfolio style of the last 20 plus years, I'm not sure that 40 is going to have a lot of allocation to treasuries and whatnot. I think it's going to be fundamentally a different type of bonds when we own bonds. So I think we can leave it on that for now.
Yeah.
Great. So I'll be back on Friday for a little market recap and the week that was or whatever we found interesting. And thank you for all your wonderful feedback and look forward to chatting with you soon. If you ever have questions or concerns or comments, please send us a text or an email. And Lauren, thank you very much for everything and for joining. And to the entire Mirador team, on behalf of Lauren and I, we'll sign off and we'll see you Friday.